Today, we are going to cut through all the noise. I mean, all of it. The talking heads, the market hype, to get down to what it really means to be an investor. It's all about finding real, tangible value in a world that's just obsessed with fleeting prices. So let's get into it.
You know, it's a question that really gets to the very heart of the entire financial world. You've got these pros with all their fancy tools and teams of researchers, and they consistently fail to outperform a simple market index. How is that possible? Well, the answer is actually a lot simpler, and honestly, a lot more important than you might think.
And there it is. That's the brutal truth. The market is driven by human psychology, right? And when panic or, total euphoria sets in, most people, and yeah, even the professionals, they all run together. This herd mentality, it is the single biggest destroyer of wealth out there. But here's the secret. Understanding that is also the source of the single biggest opportunity.
So how do we avoid being the sheep? Well, this is our game plan for today. First, we're going to dissect exactly why the herd gets slaughtered. Then, we'll build our own investor's toolkit. Think of it as a financial X-ray for companies. After that, we'll look at how great leaders make money work for them, and we'll master the absolute critical difference between price and value. And finally, we'll put it all together to sidestep the modern hype traps that are just waiting for the next uninformed investor.
All right, let's get into our first section, the sheep and the slaughter. To win at this game, you first have to understand why so many people lose. And the surprising thing is, it's not really about picking the wrong stocks. It's all about the flawed psychology that drives almost every decision the average person makes.
Look, this isn't about a lack of intelligence. This is just human nature. Our brains are hardwired for social proof. Think about it. If the whole tribe is running from something, you run too. You don't stop to ask questions. In the market, that translates to panic selling when the headlines look scary. Or when your friend starts bragging about some crypto coin, that FOMO kicks in and you jump on board. And that's the core problem. The crowd is just reacting to the price on the screen, with absolutely zero thought for what the underlying business is actually worth. It's pure emotion, totally disconnected from the facts.
And here's the real kicker. You might be thinking, okay, I'll just be smarter. I'll use fundamental analysis, I'll read the charts with technical analysis, but the data is pretty clear. Even these sophisticated methods consistently fail to beat the market. Why? Because you can analyze a balance sheet perfectly, you can spot every pattern on a chart, but you cannot put a number on the sheer panic of 1 million people all hitting the sell button at the exact same time. There's no metric for mass hysteria.
Okay, so if following market sentiment is a trap, what's the alternative? Well, we turn away from the chaos of the stock market and we look instead at the orderly logic of the business itself. And the key to unlocking all of that logic is learning how to read its financial X-ray, the balance sheet. Just like it says here, it's a snapshot. Think of it like a doctor's report from a single visit. It tells you the patient's weight, blood pressure, temperature, right now, today. It doesn't show you the diet and exercise plan that got them there, but it gives us this clear, factual baseline of the company's health on one specific day. And it's all built on two sides of a perfectly balanced scale. So on one side, you've got the assets. That's everything the company owns. We're talking cash, inventory, factories, real estate, the whole shebang. On the other side, you have how they paid for all that stuff. And that's a mix of liabilities, which is just money they borrowed, and equity, which is the money the owners themselves put in. And here's the beautiful part. These two sides must always, and I mean always, balance.
And this right here, this brings us to probably the most important equation in all of investing. You take everything the company owns, its assets, and you subtract everything it owes, its liabilities. Whatever is left over, that's the equity. This is the true honest-to-goodness ownership value of the business. It's its net worth. If a company sold everything it owned tomorrow and paid off every single debt, this is what the owners would walk away with.
And all that leads us to our anchor in the storm, book value. As you can see, it's really simple. It's just the company's total net worth, that equity we just calculated, but broken down to a per-share number. This number, this is everything. While the stock price is jumping all over the place based on headlines and panic, the book value is our measure of solid, concrete reality. It's the real, tangible wealth you own as a shareholder, with all the noise stripped away. So now we know how to figure out a company's current worth. But how do we know if that value is going to grow? Well, that comes down to management. It's all about something called capital allocation, which is really just a fancy term for a very simple question. What does a company do with the profits it makes? First, let's just take a quick peek at the company's foundation, its capital structure. This is basically the recipe of how it funds itself. Some mix of borrowed money, or debt, and the owner's own skin in the game, the equity. Using a lot of debt can be like adding rocket fuel. It can really supercharge growth. But it's also highly flammable if things go sideways. So watching how a CEO manages this balance tells you pretty much their entire philosophy on risk and reward.
Okay, let's make this super practical. Just imagine a company you own a piece of just earned $1.50 for your share. The CEO and the board now have a huge decision to make. What do they do with that cash? They really only have two main choices.
All right, on one hand, they could just hand that cash directly over to you as a dividend. And that feels great, right? It's a tangible reward in your pocket. But it's kind of like a one-time sugar high. That cash is now gone from the business forever. The other option? They can reinvest that $1.50. Maybe they upgrade a factory, pay down a loan, or develop a new product. Every single one of those actions increases the company's assets, which directly boosts the book value of your share. They're choosing long-term wealth creation over a little bit of short-term gratification.
And here's something that a lot of people get wrong, especially dividend investors. While dividends feel safe and comfortable, the most successful CEOs often create way more wealth by reinvesting those profits, especially if the business can earn a really high return on that reinvested money. So seeing that a company doesn't pay a dividend isn't a red flag. Actually, it can be a huge green flag, a sign of a fantastic growing company that has much better uses for its cash than just handing it back to you.
Okay, this is where everything we've talked about comes together. We get the psychology of the herd, we know how to calculate what a company is really worth, and we can judge how well management is using its money. Now, we use that knowledge to find our edge.
We have to draw a hard line in our minds separating two things, price and value. The price is that number blinking on your screen. It's driven by headlines, panic, greed, pure chaos. But the value, the book value, that's what the business is actually worth. It's based on real assets and real earnings, and it changes slowly, predictably as the business grows. Your job is to focus on the value and ignore the price.
The legendary investor Benjamin Graham came up with the perfect way to think about this. He said, imagine you're in business with a partner named Mr. Market. Now, Mr. Market is a little unstable. Every single day, he comes to you and offers to either buy out your half of the business or sell you his half at a new price. Some days he's just ecstatic and he'll offer you a ridiculously high price. But other days he's terrified and he'll offer to sell you his stake for pennies on the dollar.
And this just perfectly illustrates our opportunity. You see, you don't have to trade with Mr. Market every day. In fact, you can just ignore him most of the time. But when his mood swings to complete despair and he offers you a great business for way less than its real value, that is your moment to act. Market volatility isn't risk, it's the opportunity to buy quality at a huge discount from a seller who is panicking.
So let's apply this entire framework to one of the biggest hype traps brewing in the market today, this whole idea of democratizing private equity. Wall Street is finally, after all these years, letting the average person in on these supposedly exclusive deals. So the question a true value investor has to ask is, why now? Why, after decades of keeping the doors locked, are they so eager for our money?
To really get what's going on, let's look at a recent hype trap, the SPAC. As it says here, it's basically a blank check that investors give to a promoter who then goes and finds some private company to take public. It's a shortcut around the normal, rigorous process. This is a classic example of financial engineering that's really designed to benefit the insiders. And this same pattern, insiders looking for a quick exit, is now repeating itself, but on a massive scale, in the world of private equity. Just look at these dangers and think about it. Bypassing due diligence? Well, the private equity funds being peddled to you today are full of assets that haven't been repriced for today's high interest rate world. Providing an easy exit? Well, right now, private equity exits are at a 10-year low. They can't sell their companies to other companies or through IPOs. So what do? They're trying to sell their fund stakes to you, the retail investor, at what looks like a discount. But let me be clear. When the smartest money in the room is desperately trying to sell something that you're being told to buy, you are not getting the bargain. You are the bargain. You are their exit liquidity.
Which really brings us to our final thought here. The path of a value investor isn't about finding shortcuts. It's not about chasing hype or just blindly following the herd. It's about having the discipline to ignore all that noise, the patience to wait for Mr. Market to serve up one of his irrational bargains, and the diligence to actually understand what it is you truly own. So the real question isn't how to get rich quick. It's, are you willing to do the real work? Because that, right there, is where the real edge is.